The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. Here are your headlines today. Siemens sees net income jump nearly 50% in the third quarter, with the German conglomerate confirming its outlook despite some order weakness. We'll be hearing from the CEO Roland Busch this hour. Japan's Nikkei pares losses after Wall Street whipsaws back into the red as JPMorgan raises its expectations of a recession this year to over 1 in 3. But boss Jamie Dimon tells CNBC things are okay for now.
In your estimation, a normalized credit picture does not indicate we are in a recession right now.
Not at all. But I said it could get worse, but right now it's just normal.
Right now we are not in a recession.
Infinion tells CNBC the race is on to power the next wave of AI data centers and the transition to net zero as the German chip giant cuts the ribbon on a key new facility in Malaysia. And shares in Warner Brothers Discovery slumps in extended trade on a $9 billion write-down, echoing similar weakness in Disney shares despite the group's combined streaming businesses turning a profit for the first time.
The value that we're putting into the streaming service with our IP right now, with Inside Out 2 coming and with all the great TV shows like The Bear and Abbott Elementary and Shogun, we feel like we're earning pricing, and as a result, we can take that pricing.
Show and tell time for some of the big corporates across Europe at the moment, and front and centre Siemens this morning. It has confirmed its guidance for the full year after posting a third quarter net income of 2.1 billion euros. The German conglomerate pinned the quarter's performance on growing demand for electrification applications and its industrial software. However, total third quarter orders were down 15%, coming in just below 20 billion euros compared to 23.5 billion in the same period last year. We're going to be digging into this more across the show. Later on, we'll be hearing from the Siemens CEO Roland Busch. That's about 45 minutes time the interview is happening. Meantime, lots of questions still around the economy after the market was spooked recently. JPMorgan Chase CEO Jamie Dimon has told CNBC exclusively he does not think the US is in a recession. But economists at his own bank upped their bets on one coming by the end of the year. They now see a 35% chance compared to 1 in 4 previously. CNBC's Leslie Picker spoke to the banking boss on the sidelines of his annual bus tour and asked him his thoughts on the chances of the Fed achieving a soft landing.
I'm fairly optimistic that we have a mild recession, even a harder one, will be okay. Of course, I'm very sympathetic to people who lose their jobs. You don't want a hard landing, and so, but there's a lot of uncertainty out there. Does inflation really get back to 2%? I'm a little bit of a skeptic on that too, and I don't look as much at the short-term data as about the things that are inflationary but are in the future: deficit spending, green economy, remilitarization of the world, and they haven't really happened yet, but they are going to happen, and they're not deflationary.
So just to repeat some of those words then from Jamie Dimon, I am really optimistic that we have a mild recession. Even a harder one would be okay. I'm very sympathetic to people who lose their jobs. You don't want a hard landing, but there's a lot of uncertainty out there. Optimistic that we have a mild recession. I mean, it was just a few days ago that we said a soft landing was definitely in play, and now all of a sudden recessionary talks definitely in the conversation across this market. Of course, that's exactly what you saw even on Monday. Having seen that jobs number come out then on Friday, the market got spooked then, and you saw significant losses across the board. You thought you'd see a recovery because you did see the market actually snap those losses then. But yesterday, unfortunately, unable to maintain that rally that perhaps we had seen even in the early hours of trade yesterday for the US market. So you're seeing a drawdown then across the board, more than 1% loss for the NASDAQ then, which means that a lot more of those tech players also got hit then in yesterday's trading picture overall. All three averages have now declined 4 out of the last 5 days that we've been noting. The NASDAQ, in fact, is down 3.5% week to date. So that kind of tells you the weakness that we are seeing in this market. Of course, having seen that broad-based selling that we saw as well on Monday, somewhat of a recovery, but now getting worse now, 16,200 points ultimately for the Nasdaq. On the Treasury front then, well, this is interesting because we had recovered notably yesterday as global markets were still trying to get a firmer footing and rebound from this week's sell-off. As we had been noting, the 10-year yield climbed over 7 basis points, in fact, to around 3.96 yesterday. And then it's come off now. 3.91 as you see for the 10-year note there. The more rate-sensitive 2-year note then at 3.94. Question marks are, as you can see, that yield curve flattening, now around 3 basis points or so. What does that actually mean? Does that actually put the bets of a recession against the odds now that we've just been speaking about? What exactly is oscillating and going on ultimately in this market picture? So a lot of question marks still at play across the board in the Treasury market as well. Onto the dollar crosses here, and the yen was actually weaker yesterday after the Bank of Japan's deputy governor actually said that they will not be considering hiking in an unstable market. So playing down the chances of a near-term rate hike there, soothing investors' concerns then that a hike in those rates further from here could again rock markets. So question marks around the yen having fallen around 2.5% to a session low of 147 then yesterday. Currency though now sitting at 146.21, seeing some dollar weakness come through yen now at that mark. Pretty stable though with the 126 then for sterling, with the euro at 109 there. Onto the Asian market picture, having seen some news yesterday then with the shares coming down a little bit. Question marks had been placed on whether you would see a similar move today. Well, seeing a bit of a mixed picture today. A little bit more muted with regards to that movement. Tech shares still leading a stock sell-off then in markets across Asia. Nikkei leading the losses, down 1/3% so far then today. Paired those losses having jumped as much as 2.5% actually. Or should I say slumped around 2.5% earlier today. So really coming down from those losses, but still below 35,000 points, Karen.
Arabile, one of the questions we've had is just how much more is there to unwind from this so-called carry trade around the Japanese yen. Now, JPMorgan says 75% of the global carry trade has been unwound after the recent sell-off erased all gains for the year. Strategists with the bank said in a note that returns on EM, G10 and global carry trade baskets tracked by the lender have slumped by around 1/10 over the last 3 months, not just sending year-to-date returns to zero, but also cutting into profits accumulated since the end of 2022. Dimon gave his own thoughts on the market turmoil in his exclusive conversation with CNBC.
People overreact a little bit to the daily fluctuation of the market, and sometimes it's for good reason, sometimes it's virtually no reason. And you saw this one, it came way down, it went way back up, and but people are projecting, and when they project forward, it affects the markets. We don't know if there's going to be a soft landing, a hard landing, and all the things in between.
Jamie Dimon weighing in, and arguably JPMorgan has been at the forefront of some of those bearish calls that really have spooked the market, suggesting that a recession could be the state of play. I just want to link the first story we started out the show with Siemens. Yeah. We've got earnings rolling through, so a real focus on the fundamentals. And this is a stock that dropped aggressively with the rest of the stock market. So as we've seen investors really pull back and throw out just about every stock in the basket, some they've gotten back into, others they haven't. And this is a stock that they haven't really gotten back into. So I think over the next few weeks, we're looking at what has been tossed out, where the valuations stand, and what is worth scooping up at this stage. And I think if you consider where we're at in terms of the market sentiment this year, there was a lot of exuberance. It was the AI trade, it was a handful of stocks, but equally some of the indices were marching from record to record. And we kept saying, well, why and when does this actually end? Will it be the first rate cut that is the trigger? Will people, buy in the rumor, sell on the fact? Will that be the catalyst for markets to see a pullback? So it felt as though we were primed for some sort of reversal. But I wonder whether this time round it is just too many factors at play. And Jamie Dimon was saying, look, it was always going to be a year of uncertainty. He pointed to the geopolitics, housing, the deficit spending, quantitative tightening, elections, all of these things causing consternation for markets. Yet we didn't see any of that consternation really over 2024. It all came to a head in recent days. So I wonder whether it's just a change in that. If you look at some of the technicals too, there's been a lot of reporting around volatility being too low, how involved hedge funds were, retail traders in the vol trade, ultra low vol trade, but also banks standing in the middle.
this is why you then saw this volatility actually spike up as much as it did then over the last couple of days, right? And it's really just the major concern that we had played the hand that we had been dealt for so long in this market picture, right? That's why you saw that valuations had been stretched so significantly and so broadly as well. So the question mark was, when would that ultimately come down? And with it coming down, the question mark then becomes for investors now is, how far is down? You know, it felt as though the day before, investors had been looking to say, okay, things have bottomed out ultimately. But was that a sufficient enough pullback? Are things not still actually ultimately expensive at these levels? And would you still be willing to actually get in on a lot of these stocks, considering the forward Ps that a lot of them are trading at? Then, of course, you have that element of that carry trade that has been unwinding. 75% of it ultimately unwound, according to JPMorgan.
That gives me some comfort, I've got to say.
I think
it
so.
A third of the way through,
but the question is that, so there's still more to go.
Yeah.
You know, so at what point do you then ultimately believe to yourself, well, okay, now we're done. Now we've seen through the worst, and the possible greater movements then by the Bank of Japan in future. What does that then do? And if you then get cuts then from the Federal Reserve, whether they be 25 or 50 at this point, we don't know, in September especially, then what does that do to the differential as well and that carry trade?
Can I bring up the where? Where does the money come out of? Because you would argue that getting out of what was a very fast-moving event early this week might have been difficult if there wasn't liquidity in some areas of the market. So where else could we see the money come out of? Would it be US tech again? Is that an area where we've seen the washout because there is liquidity, arguably, in some of those trades? And there might be an argument for some to stay invested in an AI story where you've seen monumental growth still. So is it other quarters of the market where there's been less liquidity that still could be under pressure? That's the question I would have from here. But in terms of staying invested in these markets, and if you are having a nibble, if you're thinking that this is an entry point, and some of the asset managers have said that to us, they see this as a long-term entry point, what are you setting yourself up for? And there is a view that you may not just get one volatility event, that there could be more to come. There could be follow-ups, almost like the aftershocks after an earthquake. So are we setting up for more volatility over the coming months? The other point, though, is, are we really looking at a recession? Even if there are recessionary signals on the horizon, does that suggest that we are very much going towards some sort of hard landing, or can the Fed react? It has ammunition this time round. It's banked the rate increases. It could, if it saw something on the horizon, not saying it does, but if it did, it could move towards 50 basis point reductions. It does have the ability to reach into the toolkit, which is very different to the last number of crises where there was very little ammunition, and quantitative easing was really one of the main options.
I wonder then, if they do move 50 basis points, if 50 basis points was to be the move, would that not signal a slight worry and a slight concern from the Federal Reserve then, and ultimately create more concern then in the market, saying, oh, well, you need to do this a little bit more speedily than we initially thought you'd have to? Does that then mean you're worried about this recession at play?
Type of reaction.
Exactly, right? So I think there are key question marks, and of course it goes back to Jamie Dimon's comment where he says, does inflation get back to 2%? He is skeptical, which means that rates still do need to remain higher than they used to be for a little longer.
Yeah, plenty to pour across. I think we've got a lot of CEOs on this morning, so we'll be talking about what they see as well. Well, Berkshire Hathaway now owns more in US Treasury bills than the Federal Reserve. The Warren Buffett-led company holds almost $235 billion in short-term investments in US T-bills, as well as around $42 billion worth of cash and cash equivalents, which also includes bonds. That contrasts with the $195 billion in T-bills owned by the Fed as at the end of July.
Now, the CEO of Infinion has told CNBC the race is on to produce the line of semiconductors designed to power the transition towards renewable energy and net zero, from electric vehicles to AI data centers. JPMorgan caught up with the CEO of Infineon in Kulim and asked how the new facility will add to the bottom line, especially as the company and broader industry comes off a number of challenging quarters.
It's very attractive for us also from a labor cost point of view, but it's also the size of the facility that together then makes it the most competitive silicon carbide fab in the world in the future. And that will, of course, then also contribute to our bottom line. We are in a competitive environment, right? The decarbonization trend is there. Many players in the market want to participate in that trend. And that's why we need large facilities, competitive facilities, and in that sense, Kulim is a cornerstone in our strategy.
Right, and Mr. Hanebeck, I can't let you go without asking you this one question, because Infineon's in a very unique position to talk about two very interesting segments right now. We're talking about semiconductors and electric vehicles. Now, we've seen a bit of a slowdown in electric vehicles over the last couple of months. That's made the last couple of quarters for Infinion a bit challenging. Do you think we're coming to a point where we might see that slowdown or that uncertainty perhaps unwinding and maybe giving Infinion some much-needed breathing room in that very important segment?
None of these trends like e-mobility or others are really will work out along a linear projected curve, as many people always assume. There will be always some ups and downs, but there will be growth. And I foresee that also in many other parts of the world outside China, where e-mobility is hot. We will see new models, we will see new technologies, maybe the resurgence of plug-in hybrids, which make it attractive for you and me also to get electric cars and contribute to the decarbonization. I think there's no other way for this world than to decarbonize, and there are many ways we can contribute, as mentioned, on the energy generation side, on the energy transmission side, and of course also on the consumption side. And Kulim is part of that story.
Now, coming up on the show, Allianz beats operating profit expectations in the second quarter. We'll break down the numbers with the CFO. That'll happen a little bit later on this hour, so stay tuned for that. Plus, Annetta has actually been speaking to the Siemens CEO, Roland Busch. That's after the German giant posted a 48% rise in quarterly net profit. 48%. We'll bring you that interview in around half an hour's time. And we'll hear from the CEO of Sandoz as the Novartis spin-off also reports earnings. That exclusive interview is coming up at 8:15 CET.
Ambition to me is about doing better.
I think ambition creates a pathway.
Best advice I can give someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters, and global business leaders on CNBC.com.
And let's get to some more earnings. Veon posted a 12% jump in second quarter revenue, with the telecoms firm confirming its full-year outlook. The company says growth was driven by additional 4G customers as well as digital services users. And joining us now is Kaan Terzioğlu, who is the CEO of Veon. Kaan, welcome back to the show. Numbers crossing this morning. I can see digital services incredibly strong in terms of the numbers. Those digital revenues are up 83.3% year over year. Just run us through the quarter.
Great to be back, Karen. And it's also great to be back with $1 billion quarter. As you said, our revenue is up more than 12%. Our EBITDA is up more than 10%. And more interestingly, our direct digital revenues, this is the first time we are disclosing this, has reached more than 10% of our total top line and growing at 83% year on year. This really underlines the fact that our strategy of being a digital operator, being a consumer and enterprise services company, which happens to have a telecom license, our ability to tap into adjacent markets is working. And one thing I would like to highlight, this time last year, the weighted average inflation in our countries were around 17.4%. And we were growing in local currency terms about 18. This year, the weighted average inflation in the countries that we operate in is slightly less than 10%, and our local currency growth trails at 16. That tells me that our promise to the market that we can grow our business in a healthy way above the inflation with real fair value pricing is also happening. So overall, it's a very, very good quarter for us.
An interesting point there around fading inflation, still the strength in numbers. Can I ask you about the digital services part? Because this is an area where a lot of the European telcos have been attempting to grow, but it hasn't really moved the needle on profitability. As you talk about the strength in digital services, how much of this is down to the average revenue per user versus the addition of new customers? Because I can see active users actually went up a huge amount by 47% year over year.
Yes, actually, there are two important vectors that the digital services impacts our growth. Vector number one is very simple. The more engagements you have with a customer in terms of the digital services you provide, the more meaningful in their lives, makes you more relevant to the customer, and allows you to actually keep them longer, retain them longer, and increase the ARPU. That's what's happened when we are in the financial services business, entertainment business, education, and healthcare. And this is basically what drives our telecom growth. However, there is a second vector. As you develop digital services, which are standalone applications and which are actually world-class features in the financial services area or entertainment area, they started to create direct revenues as well. As we enter into nano-loans in Pakistan, or as we enter into entertainment business in countries like Ukraine, Pakistan, Bangladesh, we start to sell subscriptions. We started to generate advertising revenues. And we have actually a health platform which starts to create healthcare services subscriptions revenues. And all these things help us on both fronts. And this quarter, we announced that our direct digital revenues, by creating financial services solutions to our customers or entertainment subscription services to our customers, have reached 10% of our total. That's an 83% year-on-year growth in hard currency. And also, we keep on growing our ARPU from 3% to 25%. And now it is clear that as our customers consume more of our digital services, their ARPU increases and their retention rates gets much better. So we get the benefit of both sides with digital services, and I will keep on reporting our direct digital revenues from this quarter onwards.
Yeah, Khan, very interesting. I mean, one wonders as well, what else one can do in 1,440 minutes when considering your digital strategy as well. How is that actually going? And is ultimately the traditional telco market just too saturated at this point and doesn't offer sufficient growth for a business? That's why you have so many of the bolt-on other services that you supplemented with.
Look, I would not say for our markets, which are frontier markets, and I consider ourselves as the bellwether of the frontier markets telecoms, the saturation is absolutely not there, because today we serve 520 million people in the markets. 1 out of 3 is our typical SIM customers, telecom customers. But now we have also reached almost 1 out of 4 being our digital service customers. Believe it or not, but still 50% is the average 4G penetration in these markets. Over the next 3 years, there will be 100 million more 4G customers. And I'm confident that we will get our fair share and we will fight for the rest. And that's why both digital services business has a huge potential to grow. It's an accelerator, but also the main telecom services has a lot of room to grow in the markets that we operate in.
Yeah, and what about that? I mean, why, or let me put it this way, is the 5G strategy not ultimately an investment in a technology that has gotten perhaps a little bit cheaper now? Why is 4G still the one that is still working so much for you? Does 5G perhaps lack the efficiency at this point still? And at the same time, what does the Gen AI strategy then look like for your business and for your clients then moving forward?
So first of all, from a consumer perspective, they care about the digital service they get. They care about the content they have. They love to watch the cricket games. And, nobody thinks about whether they watch it on Wi-Fi, 4G, or 5G. So we should forget about these technological terms to define, what the technology is and what services we provide. A telecom company will talk about 4G, 5G. We talk about digital services, being relevant, being meaningful to the customer. And frankly speaking, we have not launched 5G in any one of our markets, and we are gaining market share in all of them, and we have the best net promoter scores in all the markets that we operate in. So it's not about the number before the G, it's actually about what matters. It's the customer. Now, coming to the Gen AI, and in my definition, I mentioned this before in last call as well, there is nothing artificial about artificial intelligence. This is augmented intelligence. And for our markets, we take it very seriously. It's not about, providing generic solutions. It's about making a doctor in Dhaka the best doctor in the world. It's about making a teacher in Islamabad the best teacher in the world. And doing it not in English, French, or Japanese, doing it in Punjabi, Urdu, Bengali, Uzbek, Kazakh, Ukrainian. And we are working with the research institutes in the countries that we operate in, as well as international institutions, to create the small language models that will make a better version of our customers, whether they are a teacher or a doctor. I think that's where the value will come, and it's going to be the next wave of growth for us in frontier markets.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.